Good afternoon, this is Sean Golding for Golding & Golding, here to talk a little bit about offshore, foreign, international cryptocurrency. Is it reportable? Do you have to pay tax on it? What if you don't bring it back to the US? Let's go through the basics. First things, I always like to start out with who has to report and pay tax in the US and what are the different categories. So we focus on individuals, 3 categories of individuals: US citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. That last category is basically for taxpayers who use accounting days tests. If they're not a U.S. citizen, they're not a permanent resident, but maybe they're here on a visa. It doesn't have to be, but typically you're here. It could be a B1, B2 travel visa. It could be an E2 or E3 visa. It could be an L1, H1B, any type of visa essentially, okay? Unless an exception, exclusion, limitation applies. Some taxpayers live overseas and they make a treaty election to be treated as a non-resident alien for tax purposes. They may be able to avoid having to pay U.S. tax on income that's not sourced in the U.S. But U.S. sourced income is still taxable even if you make that election. IRS takes the position international reporting forms are still required. You may disagree. Many people do. There was a case that came in favor of the taxpayer regarding the FBAR and ROS day, but the FBAR is a little different because it's not a tax form, it's a FinCEN form. So baseline, if you're a U.S. person for tax purposes, whether you live in the U.S. or abroad, whether the income is generated in the U.S. or abroad, you're still taxed on your worldwide income. So let's jump into offshore crypto. You know, when people hear the term offshore, they automatically think of things like the Jersey, Belize, somewhere where there's no treaty and people like to create offshore tax havens. But offshore for these purposes just means international, foreign, outside of the United States. So there's 3 main forms to consider when you have cryptocurrency outside of the United States. The first one that most people are aware of is the FBAR. The FBAR is Foreign Bank and Financial Account Reporting. So the current rule is if you have a pure crypto account, that is not reportable for the FBAR. But if you have a hybrid account, so maybe you've got cash or other investments in the account as well, then the account is reportable. Okay? So it's important to note that if you're moving assets other than crypto in and out of that account, wallet, whatever, it's still going to be reportable. Okay? If it's purely crypto, for now, you can get away with it. There was a notice about 5 years, I think it's 2020-2, which basically says, hey, we don't have that rule right now, but there's every intent of requiring crypto reporting on the FBAR, similar to other foreign accounts. FATCA is the Foreign Account Tax Compliance Act, Form 8938. It's a newcomer, relative newcomer in the world of international tax. It came around in 2012 for the 2011 return, and it's similar to the FBAR. It's got higher threshold and it requires a little more reporting. FATCA is to report foreign accounts and assets, so most tax practitioners will take the position that crypto, foreign crypto, is reportable for the 8938, even if it's not reportable for the FBAR, whether or not it's in a hybrid account. Okay. PFIC is passive foreign investment companies. Why is this important? Because a lot of times taxpayers may invest in things like foreign ETFs, mutual funds, or similar unit trusts, CCOVs, things that are considered PFICs, passive foreign investment companies. So if you're invested in, just to keep it simple, like a foreign crypto ETF, then it's reportable for FBAR and 8938 generally. Okay. And then you may also have to file the 8621, because with the 8621, it's used to report PFICs. So one thing to keep in mind is, even if it's a pure crypto ETF, typically there's going to be some cash fund associated or similar, and so that would require the FBAR, and then the 8621 is to report foreign ETFs and mutual funds and unit trusts and similar things like that if they fall into the PFIC, which is passive foreign investment company. It doesn't mean you own a foreign holding company, for example. It could be fractional ownership, but if you meet the threshold requirements, then you have to file. The next issue is income reporting. So a lot of different countries have different rules and regulations and whatnot when it comes to cryptocurrency. But in general, if you're a U.S. person, then the U.S. is still going to tax you on your worldwide income. So, for example, if you have capital gains from selling crypto, it's reportable as income. If you receive employment income as crypto, it's reportable as ordinary income, right? Even if you're in a foreign country that doesn't tax crypto, well, the U.S. is still going to say you're taxed on it. Fund income is something to be cautious of. If you've got dividends, if you have capital gains, if you have interest, any of that type of passive income associated with the fund, that's going to be reportable and taxable as well, even if it's tax exempt in the foreign country. If you happen to have paid foreign taxes on your foreign crypto income, then you could typically claim foreign tax credits so that you can reduce or eliminate U.S. tax liability on your foreign crypto. If you're out of compliance, the IRS has various programs to help you get into compliance. If you're willful, there's the VDP program. If you're non-willful, there's programs like the streamlined procedures, the delinquency procedures, and reasonable cause. We have a ton of free information available on our main website and our sub-website. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.